You see the price coiling, tightening like a wound spring. You feel it in your bones. It's been trading in a narrow channel for months, a monotonous back and forth that has drained the life out of the market and your patience. You tell yourself, this is it. The big move is coming. So you place your bet. You buy as it nudges the top of its cage, and then nothing. It slumps back to the middle of the range, taking a small piece of your capital and a large piece of your confidence with it. A week later, you try again, this time shorting as it touches the bottom. It snaps back with venom, as if personally offended by your presence. You are being bled dry by 1,000 tiny cuts, all while the market does absolutely nothing. The real torture is not the loss of money, but the loss of sanity. You are trapped in the quiet room and the silence is deafening. This is the psychological warfare of the trading range. And it is a battleground where more accounts meet their end than in any spectacular crash. The market spends most of its time in these periods of consolidation. The great sweeping trends that make fortunes are the exception, not the rule. The range is the market inhaling, gathering energy for its next significant move. But the human mind is not built for this kind of stillness. We are creatures of action, of narrative, of progress. We crave resolution. A market that goes nowhere feels like a personal affront, a waste of our precious time. This impatience is a fatal flaw. It transforms a speculator into a gambler. The gambler needs the thrill of the bet, the constant spin of the wheel. He cannot bear to simply sit and wait. So he projects his own desires onto the market. He sees breakouts where there are none. He mistakes minor fluctuations for the start of a major campaign. He is fighting a war that has not yet been declared. The core of this error is a fundamental misunderstanding of your role. You are not here to make things happen. You are here to capitalize on what is already happening. Your job is not to predict the future, but to correctly interpret the present. The tape is telling you a story. A range-bound market is telling you a story of equilibrium. The forces of supply and demand are in a temporary truce. The large interests, the intelligent money, may be quietly accumulating shares from weary holders, or they may be distributing their holdings to an eager but uninformed public. They do this slowly, carefully, without disturbing the price. Your frantic attempts to guess the direction are merely providing liquidity for their patient operations. You are the nervous amateur in a high-stakes poker game, giving away tells with every bet, while the seasoned professionals sit silently, reading your every move, waiting for you to exhaust yourself before they show their hand. Every time you buy at the top of the range and sell in a panic at the bottom, you are transferring your capital to those who have the one weapon you lack: discipline. They are content to wait for weeks, for months, because they understand that the profit from the eventual move will dwarf any small gains made from scalping inside the noise. They are not interested in winning small skirmishes. They are waiting to win the war. Jesse Livermore, or Larry Livingston as he was known in print, consistently stressed that Wall Street extracts a heavy cost of instruction for every lesson learned the hard way. Fortunately, the core principles he developed to survive these expensive market penalties were captured for posterity by Edwin Lefebvre in the 1923 masterpiece, Reminiscences of a Stock Operator. It stands as the finest possible literary training ground, allowing you to absorb decades of painful operational experience without ever having to risk $1 of your own capital. To ensure this timeless wisdom translates accurately to the modern computerized arena, we advise seeking out the Max Davidson Annotated edition. Davidson's careful commentary is indispensable for bridging the gap between Livermore's era and ours. A link to this essential edition is provided in the description below. Consider the great copper stocks of the early 1900s. I remember a time when a particular name in that sector, let's call it Anaconda Consolidated, entered a long and arduous period of slumber. For the better part of a year, it etched a pattern on the tape between $48 and $52 a share. The world at the time was a cauldron of uncertainty. Industrial expansion was the talk of the town one week, the threat of a global conflict the next. And Anaconda's price reflected this perfectly. Every time it climbed to 52, the newspapers would be filled with optimistic chatter, rumors of a new smelting process, whispers of a colossal government contract for munitions. The public, starved for action, would rush in, convinced this was the beginning of the great ascent. The stock would absorb their buying for a day or two, churn heavily, and then, like a tired old man, sigh and settle back down to 50. The optimists would be trapped. Then the mood would shift. The stock would drift down to 48. The news would turn sour. Reports of labor strikes, fears of a slowdown in manufacturing. The same public that had bought at 52, now terrified of a collapse, would dump their shares for a loss. The stock would absorb their selling, firm up, and slowly, quietly levitate back toward the middle of its channel. This was a masterclass in accumulation. The composite operator, the big money, was a vast sponge, patiently soaking up every share offered by the impatient and the fearful. They were in no hurry. Their goal was to acquire a massive line of stock without driving the price up against themselves. The range was their hunting ground, and the public's emotional swings were their greatest asset. I watched this process for months. I made no move. To an outsider, it would have looked like I was doing nothing. But I was doing the most important work a speculator can do. I was observing, and I was waiting. I noted the character of the action. On the declines, the volume was light. The selling was not aggressive, it was tired liquidation from discouraged holders. On the rallies to the top of the range, the volume would swell slightly, but it had no force, no follow-through. It was the buying of hope, not conviction. I was waiting for a change in character. I was waiting for the stock to tell me that the period of absorption was complete, and the period of marking up the price was about to begin. The day it happened, it was unmistakable. The stock opened quietly at 51. By mid-morning it was trading at 52, but this time something was different. The volume was immense. It was not the choppy, nervous trading of the public. It was the steady, powerful buying of a single, determined mind. It moved to 53. It did not pause. It did not look back. This was not a test of the old resistance. This was an assault. The line of least resistance had suddenly and violently shifted upward. The sellers who had been present at 52 for an entire year had vanished. They had either been bought out or they were now pulling their offers, realizing a powerful new force was in control. I did not buy at 52. I did not even buy at 53. My first entry was at 54. Why? Because I was not buying on hope. I was buying on the undeniable evidence of the tape. I was paying a higher price, yes, but I was buying with a much higher degree of certainty. My risk was not in the price I paid, but in being wrong about the direction of the trend. By waiting for that confirmation, that powerful thrust on monumental volume, I had reduced the risk of being wrong considerably. From there, Anaconda Consolidated did not trade in a range again for a very long time. It began a historic advance, a relentless climb that eventually took it to over $80 a share. And all those who had been chopped to pieces inside the 48 to 52 channel were left behind, either too financially broken or too psychologically scarred to participate in the real move. They had exhausted their capital and their will in a battle that didn't matter, just before the main event began. I give you the discipline and the mindset. I can teach you the patience to sit through the long, quiet periods of preparation and the courage to act decisively when the moment is right. This is the art of speculation, the mastery of one's own human frailties. But for the precise mechanics, exactly where, how, and when to execute the trade, you need the structure and the science of a proven methodology. You need to understand the anatomy of these ranges, to identify the subtle signs of accumulation and distribution that precede the major moves. For this, you need the work of my contemporary, the brilliant analyst Richard Wyckoff. He codified these market movements into a practical, repeatable system. I have left the link to the official channel on Richard Wyckoff trading methods in the description below. His schematics will give you a blueprint for the market's behavior. Use it to complete your arsenal. My philosophy and his methodology are two sides of the same coin. So how do we apply this lesson to the markets you see on your screens today? The names and the machines have changed, but the underlying human drama is identical. Let's consider a modern example, not in a glamorous technology name, but in something more fundamental, like a major steel producer. Imagine a company, a titan of industry, that has been trading between $100 and $110 for the past 8 months. The news is a confused mix of infrastructure spending bills and global tariff disputes. The stock is a battlefield for bulls and bears, and neither side can gain a lasting advantage. This is your Anaconda Consolidated. This is your quiet room. Your first task is to resist the urge to play. Do not try to scalp a few points buying at 101 and selling at 109. The transaction costs and the risk of a sudden sharp move against you will erode your capital. Your only job is to define the boundaries of the cage and watch the animal inside. Use your charting software to draw 2 horizontal lines. One at the support level, around 100, where buying consistently emerges, and one at the resistance level, around 110, where selling consistently caps the rallies. Now you become a student of volume. This is the most critical element. As the stock meanders between these 2 lines, observe the volume patterns. Is the volume drying up? Is it becoming progressively lower with each swing? This is a constructive sign. It suggests that the supply of stock available for sale is diminishing. The weak hands have been shaken out. The stock is passing into the possession of strong, patient holders. Conversely, if you see heavy volume on declines and weak volume on rallies, it may be a sign of distribution, where large interests are unloading their shares. The character of the volume tells you the secret intentions of the smart money. You do nothing until the conflict is resolved. You wait for the breakout. Let's say one morning the company announces better than expected earnings. The stock gaps up and opens at 112. Is this your signal? Not yet. A gap can be a trap. You must wait to see if the price can hold above the old resistance of 110. But most importantly, you must consult the volume. Look at the volume bar on your screen for that day. Is it average? If so, be extremely cautious. This could be an emotional, news-driven spike that will quickly fade. But if the volume is a tower, if it is 3, 4, or 5 times the average daily volume, then you are witnessing a genuine event. You are seeing the footprint of institutional capital. This is conviction. This is the powerful buying that signals the start of a new, sustained uptrend. Your entry should be methodical. Perhaps you buy a partial position as it proves it can hold above 112. You might add to the position if it pulls back to test the 110 level, the old ceiling, and that level now acts as a new floor. Your protective stop-loss order is placed just below that breakout point, perhaps at 108. If the stock falls back into the range, your premise is invalidated. The market has told you that you were wrong, or at least premature. You must obey without question. You exit, take the small, manageable loss, and you go back to waiting. A true breakout, the kind that creates a lasting trend, should not look back. It should not return to the scene of the crime. Let's walk through the potential points of failure because the market is a master of deception. The most common trap is the false breakout, or what some call the bull trap. The price pushes through the resistance level, say to 111, on mediocre volume. It hangs there for a day, enticing you and other hopeful traders to jump aboard. Then, without warning, the floor gives way, and the price crashes back down to 105, trapping everyone who bought above 110. The only defense against this is twofold. an absolute adherence to your stop loss, and a strict insistence on seeing massive, undeniable volume before you commit any serious capital. Volume is the ultimate lie detector. A price move without volume is a rumor. A price move with overwhelming volume is a fact. Another painful scenario is the whipsaw. The stock breaks out to 112 on strong volume. You buy. The next day, a broad market sell-off drags everything down and your steel stock is pulled back to 108, triggering your stop loss. You are out with a loss. Then, the very next morning, the general market stabilizes, and your stock rockets up to 115 and never looks back. You were right on the stock but wrong on the timing, and you were shaken out. This is perhaps the most emotionally taxing experience in trading. The solution here is not to abandon stop losses. That way lies financial ruin. The solution lies in position sizing. On an initial breakout, perhaps you only commit a quarter or a third of your intended full position. This smaller size allows you to set a slightly wider stop, giving the trade more room to breathe and absorb the market's natural volatility. You can then add to the position as it moves in your favor and proves its strength, raising your stop loss as you go. You must accept that you will never eliminate these whipsaws entirely. They are a cost of doing business. The goal is to ensure they are small, manageable costs, not catastrophic ones. Finally, there is the paralysis of missing the move entirely. You see the breakout, you see the volume, but you hesitate. You want more confirmation. You wait for a pullback that never comes. The stock moves from 110 to 140 in a straight line, and you are left at the station, watching the train disappear over the horizon. The temptation now is to chase it, to buy at 140 out of pure fear of missing out further. This is a cardinal sin. Chasing a vertical extended move is the lowest probability trade you can make. You're likely buying at a temporary exhaustion point, just as the early intelligent buyers are beginning to take their profits. The discipline here is to accept that you missed it. You let it go. There will always be another opportunity, another stock coiling in a quiet range, another perfect setup. Your capital is your ammunition. You do not waste it on desperate, long-range shots. You save it for the high-probability opportunities that are sure to come if you are patient enough to wait for them. The market is a tide. It ebbs and it flows. The range is the ebb tide, the quiet withdrawal of water from the shore, exposing the seabed. The breakout is the turning of that tide, the first powerful surge of the incoming wave. Most people make their mistakes during the ebb, scrambling over the rocks, trying to catch fish in shallow pools, only to be caught unprepared when the real power of the ocean returns. The speculator's job is to sit on the cliffs, to watch the tide patiently, and to understand its rhythm. He does not fight the ocean. He waits for the wave and rides its immense, inevitable power. The great moves do not come from cleverness or constant action. They come from correctly assessing the market's underlying condition and sitting tight. A trading range is a condition of balance. A breakout is a condition of imbalance. Your profits will come from identifying the transition from balance to imbalance. That is the entire game. The tape will tell you everything you need to know, but it speaks in a quiet language. It speaks in the language of price and volume. You must learn to silence your own inner monologue, your hopes, your fears, your impatience, so that you can hear what it is saying. Patience is not a passive act of waiting. It is an active, focused observation. It is the highest form of discipline. The market will tell you when it is time to act. Until then, your job is to watch, to listen, and to wait. Stay disciplined.